So, state of the market, always in fluctuation. Everything's moving, fluid. This presentation is going to be one you're going to really want to pay attention to. Jason talks a lot about the state of the multifamily market. As I mentioned, we are both in the weeds every single day looking at deals. I just got off the phone with him. We're talking about interest rates on a deal, storage facility that we're locking up. And like, we're always talking to lenders, talking to banks, talking to property managers. And what we do is we get all that information from all of our conversations that we have every day, because we're doing this full time. And then we bring it to you and tell you guys, here's the state of the market. This is how we see things. This is where we see things going. Obviously, the world's going in one direction. The real estate market's going a different direction. Everything is segment by segment. So like Class A, Class B, Class C, all operates independently of each other. And then also each market operates independently of each other. The markets in California, New York, and those kind of states are way different than markets in Tennessee, Kentucky, Alabama, Carolinas. So understanding the state of the market on a macro level and a micro level is super important for you guys. Obviously, there's a lot of reasons why I'm not investing in certain places and I invest in others. And also just getting a good understanding of the macro state of the market is really important. So without further ado, I'm going to bring on Mr. Jason Yarusi to talk about the state of the multifamily market. Buckle up. Here he goes.
Top 10 reasons to invest in U.S. multifamily. There's going to be a lot of information on these slides. We're going to hit on the key points. Multifamily on itself has very attractive risk-adjusted returns and relatively low volatility. Unlike the stock market or bond market, where each and every day there's just new information coming out, or the crypto market, where each and every day new information is affecting our mind and we're making decisions on the moment that's affecting our overall returns. You buy well in real estate, you hold, and you find the next buyer, the next potential buyer, or you hold, but you don't have the potential to jump in and out of these investments in a place that can put you in a place to make bad decisions today. Next, healthy demand. The demand out there, as you've seen in the multifamily space, continues to grow. There's not enough housing. There's not enough good housing. So if you remember these two parts here, if you can provide good housing to workforce community, you're always going to have a fitness need. Anything we're building today, new construction, it's not meeting the demand driver of what's needed in America. We need affordable housing, and it just does not exist out there. So if you can find apartment communities that are not performing well, make them perform better, make the community overall function better, it's going to improve the revenue, it's going to moderate your expenses, it's going to create great returns for both you and your investors, and you cannot lose with that business plan right there. Next, favorable regulatory environment. Many of these states and the government has learned that they are not good at being landlords. So they put in a lot of rules and a lot of regulations to empower us as property owners to go forward to provide this great affordable housing to the need of the current U.S. environment. High degree of transparency. We see what things buy and sell for. We understand where our price points are. We understand what our return ratio is and basically our risk threshold. So it puts us in a great spot to know what we're buying, know why we want to buy it, know what others are buying at, so we compare like kind of investments to make sure it's fitting our investment criteria. Liquidity with multiple funding sources. You have everything from retail investors to hedge funds that want to jump into this space. On the loan side, it's a very safe investment for lenders. So you have everything from community banks to regional banks to large business banks to credit unions to bridge banks to all kinds of different players that want to get into this space because of the ability for this asset class to continue to perform each and every day. Diversified credit risk. Your credit, and we don't think of this a lot of times, but when we have our tenants in there, they each have a credit profile. And instead of having one tenant where we're seeing a lot of office buildings and a lot of retail buildings massively affected because they're locked in these long-term loans with tenants that can no longer perform or no longer want to perform, you may have 20, 50, 100, 200, 300 tenants in there with great credit profile that will continue to pay rent and continue to allow your building to perform. Next, short-term leases. Another driver that pushes back in the office space, the industrial space, the retail space is you lock in 3, 5, 10-year leases. And on paper, why that certainty may seem good, if we face an upside in the market or a downside in the market to put those investments at risk, because those investments can't react We're here in the multifamily space, the residential space, you have year leases. So you can adapt. You can accelerate your rents like we've seen in the last few years to meet the market demand. Or we can moderate rents at this part to continue for our asset to perform. So we're in that great spot to perform as the market allows on the upside and on the moderation side. Next, relatively low capital expenditure. Go in there, you find a building that's not performing, you renovate it based on need, based on choice to what it needs to perform, or also to meet the market conditions. There's going to be choice renovations that we'll talk a little bit later with the asset management presentation. And lastly, you can empower teams. Third-party leasing and management options here where you do not have to do the work each and every day. We manage about 400 of our units. The other 2,000 or so, we source out third-party management in select markets that empower that decision forward so we can be using our best energy each and every day to find great opportunities and protect our investments for our investors. And that's what we're going to talk about a lot today is how you can do the same in the markets that you want to operate in. All right, so benefits of commercial real estate investments. Less risk, right? You can treat this like a business. I remember I have had a restaurant that was 12 seats. I've had a restaurant that was 300 seats. If you think about both sides of those, both same business plan. Well, what's riskier? The 12 unit, right? The same expenses, the same overhead, the same lights, the same people, but dinner is only 2 hours long. So if I can have 300 people come in there, I can increase revenue compared to 12. It puts me in a much safer environment. Same thing here with the residential world. If you have one house, you have one tenant. You either have income or you have no income. You have a tenant that's paying or you have a tenant that's not paying. You have one roof where it has to be covered by that tenant. The bank, their exposure is that one tenant and you as the safeguard. On the other side, you have a 100-unit building with one roof with 100 credit diversified tenants that are now paying rent. Like if you go down 5 tenants, you're still at 95% occupied. So you still have 95 tenants here that can pay your rent, that can cover your expenses, cover your mortgage, provide to put the lender in a good place where they feel safeguarded and put you in a great spot to make returns and make cash flow for your investment. Diversification, right? You can diversify across property types, diversify across markets, you can diversify across business plans. So instead of having all your eggs in one basket, right, you can put yourself in a diversified state based on your investment decisions on how, where, and why you want to invest and when. Potential for high returns. One of the unique parts about real estate investments is the ability to utilize debt to empower your returns forward. Typically, the debt, even in today's market, is going to be cheaper than the equity providers that will come into your deal and the returns that they're going to seek. So as you do this here, you'll be able to bring down your overall cost of your capital to provide and maximize returns for your investors. So utilizing the right debt will put you in a great spot to get the best returns out of your investment. And less work. It's not to say it's not work. So we don't want to fool anybody here. But with this, because these are large projects, these can be a couple $100,000, can be millions, tens of millions of dollars, these projects. Because of the size of these projects, teams are able to form, and you're going to hear from a number of them that have come together where they were trying to do it solo, and they formed here through seven-figure multifamily as teams and have accomplished their goals because instead of trying to do all and wear all the hats, they were able to put the roles and put themselves in the best position to perform, and then together as a team have accomplished their goals from buying just their first building to now tens of millions of dollars of real estate because they're each doing a select role in a big investment, empowering that investment forward. So some of the reasons why investors choose to invest in apartment buildings: monthly income, recurring income. You have the appreciation potential. As we've seen, pick the right market, put yourself in the right spot, you have growth over time. That's one thing that you can look at, is that your property is going to be worth more for many different reasons we'll touch on shortly. And also, through the renovation plan you have, you can force the renovation forward through select improvements that not only create more income in the property, but again, reduce or moderate your expenses, which bring up your bottom line and put your value of your apartment building at a much higher level. Tax benefits. Another thing, the government, of course, has figured out that they are not great at managing investments, so there's a number of tax benefits that come out. A lot of these we seek, everything from a 1031 exchange to the depreciation benefits that you can build into there to accelerate your losses based on paper losses to offset gains on other investments. and leverage. We talked to this a little bit. By using debt to finance the purchase of apartment buildings, returns can be used to maximize the value of your investment and bring down your overall cost of capital. Continue to look at your part as you are creating a business here. This is not something that we're going to go into engage and try out. You create a business. This can be a mile marker in changing the course of your life by taking strategic moves to set up a business plan, put yourself in the right position, understand the drivers that we're going to talk a lot about in these next few days to put you in the best place to perform and succeed. So why has the commercial real estate market performed so well over many years? Strong economic growth. We see it everywhere, right? Regardless of how much you're trying to kick down inflation right now, the job market's strong, a lot of jobs. If you're in good markets that have path of progress, that have job drivers, you're going to continue to see people come there. It's going to continue to put downward pressure on the housing market. There's not enough housing. We can't build it quick enough. We can't even make those most of the time pencil out that we can want to build them. So in that part, it's going to continue to put strain on the housing market and continue to elevate rents. Next, low interest rates. We've been in a low interest rate environment. A lot of you talk to your parents, talk to your grandparents. They'd be laughing at us right now if we say, hey, we're into, primes at 8.25, right? They will be laughing at us today because of what they went through in time of need where interest rates were 15, 17%. So although rates have risen, they're still at average or lower than they have been historically for the last 30, 40 years. Rising rents, we talked a lot about this, right? The housing market, people can't afford a house. Who here bought a house in the last 2-3 years, right? Yeah, a lot of us in the room. So you think about that. How many open houses you have to go to? How many houses you have to go offer on? How many other people were offering in those houses in the right market? You're one of 30 trying to get that house. The other 29 did not get that house. That mortgage payment that they could afford, they could get a $350,000 house for a $1,600 mortgage payment. Now the $1,600 mortgage payment can only get them a $270,000 house. Problem is they don't exist. Houses that are worth $350 are still $350 today. They can't afford them. So they're going to choose to rent. They're going to choose to rent for longer. So again, if we get back to our core thesis, find housing that's not performing, provide good affordable housing. You're always going to have a pool of renters who fit that blue-collar workforce nature that are going to be there to support you and your business plan and empower your investment forward. Increasing demand for industrial space. We've seen a lot of jobs come in. Those jobs bring up the need for industrial space, keep people here, bring people to the market. Think about the market you're in. If you can't talk to why people are there, you have to look either deeper or ask yourself if you're in the right market. We started out in Louisville, Kentucky. Louisville, Kentucky has GE, UPS, FedEx, Churchill Downs, Humana, Aetna, the Yum Center, University of Louisville, right? Did I say Churchill Downs? If I didn't. However, if you look at all those, if one of them stops performing to its match, you have all these other employers that continue to power forward the market. Think about the market you're in. Think about the use case of what's going to bring people and why they continue to go to that market. That's why we see so many people going to Atlanta, so many people going to Nashville. And when you think about that, that's going to continue to put pressure on the housing stock that's already failing to meet the demand. Strong demand for multifamily properties, right there, it's continuing to boost the properties. Low demand, increased valuations. Additional factors driving the market, strong demand for housing. Population's growing. We don't see many parts where it's continuing to slow down. It's going to continue to put a strain. Affordability challenges. We talked to the inability for people to afford a house. They still want to get outside from living with their parents. They're going to put into want to be renters and want to be renters for longer. Changing demographics. People want to rent rather than buy. You hear from a lot of people. The dream was get a house when you were 20, 21, 22. Now people aren't getting married till they're 30. Maybe mid-30s, maybe aren't getting to a house in the mid-30s. People are going to stay renters longer for many reasons. One by choice, one by cause. And with that, it's going to continue to put the need for rental properties right here in front of all of us. Strong job market, jobs are plentiful. Even with this, if you look at the tech companies, we hear the big news, they're laying off 7,000 people, right? Well, they've hired 35,000 in the last 2 years. So if you look at that, they've only cut really back to where the need is. They actually haven't reduced it. They've just now on paper made it look good for their investors that they've cut back to meet the need. But jobs are still accelerating. You just have the markets growing plentiful point, and the need for housing has continued to grow. Increased urbanization, big cities, a lot of attractions. A lot of you come to Nashville, you see all the things going on. People want to live where things are taking place. So you can continue to see that need for housing. Right now in Nashville, 25,000 units coming online right now. That may hurt a bit in the moment of absorption, but it's going to be quickly eaten up over the next few years as people continue to flock here to Nashville. So why multifamily is investment? It's the most secure sector of U.S. real estate. Talked a couple of that part, safer than single family, safer than anything on the office side, safer than industrial. Easy access to debt. Lenders would rather loan on your $10, $20 million property with 50, 60 tenants that can pay rent compared to you on your own trying to buy a 2-unit or a 3-unit, because it's coming back to your credit worthiness and your ability to provide income to that property if it can't perform. Banks, they just love lending on this. Target properties are often undermanaged or institutionally owned. Even a property that's managed well may not have the vision to see the business plan that you have in mind that can create the most value for that property. I'll talk a little bit later about our first property, some of the things that we found in that property that were easy changes that provided max returns for our investors in a very short timeline by making easy change on the property that set the stage to get us out of the gate with a fantastic first property, but just were not being maximized by prior ownership. Unmet need for workforce housing. Nobody's building Class C today. Affordable housing is hard to get out of the gate. A lot of that is coming up to expiration. So you're going to continue to see this need for workforce housing. And we're going to continue to touch on this. There's not enough housing. Not enough housing. Real estate historically has performed better than stocks and bonds. So if you see on this rolling 10-year average, 10.5%, the S&P 9.8%, bonds at 5.7%. All day long. Most people, right, they get into the stocks, but they get scared by the news, jump in and jump out, right? So ideally, even if they're investing in the right years, they're not picking the right times, and they're basically hedging their upside potential by paying attention to the news. Here with real estate, you buy good investments with long-term debt, with reserves, with cash flow, you have a winning investment. 3 reasons why real estate has outperformed stocks and bonds over the years. Inflation hedge. It's a tangible asset, right? It's something you can touch, so it's always going to valuation. Here, people in the crypto world, people in the stock world, what's stopping your investment going down 25, 50, 75%? Zero. The business is always going to value. The land is always going to have value. It's a tangible asset that will always find its way to hold value in some light, and your performance with that property will create even more value with that property over time. Limited supply puts upward pressure on, of course, rents and also pricing. Demand, strong demand. We need 16.5 million houses this decade. We're on course to build 10 to 11 million. We haven't met the needed demand since 2007, 2008. Developers were building a ton, they're going crazy, got burnt. Today, they're trying to get out the gate. It's like, man, we need housing. Well, okay, that's great, let's build housing. Well, regulatory, right? We can't find the zoning to put the housing in where the housing should be. Okay, well, we can find the zoning. Well, we can't find people to build these things because there's no employees or no workforce out there to build the houses. Okay, well, we've got the workforce. Oh, supply strain. There's no doors, no windows. You pick the week, right? Okay, we got the windows. Oh, well, the cost to do this has risen up so much, it doesn't make the project pencil out. So if you can find good existing buildings in great areas, put value to them, you're always going to have a home to make massive returns in multifamily real estate. Tax benefits, depreciation offset. There's a thing in the tax code called cost segregation. It was 100% bonus depreciation up until last year. This year, it's 80% offset bonus. And what that means is that you can push forward the depreciation that you usually streamline over 27.5 years, 31 years, depending on the type of investment, into 5 and 15-year categories. And you can push that losses forward to take that for you and for your investors, depending on how you invest, and offset your gains. Another massive benefit to real estate. Multifamily real estate, you can get cash flow, appreciation, both by the market, both by forced, depreciation and tax benefits, debt pay down, diversification. Think of another investment that can do that for you. All of those components. And the great thing is when you have investors on there, they may only want 1 or 2 of those things, right? And then the same investor, another investor's investing in that deal may love the other 2, 3, and 4 of those. There's so many ways for us all to win in this investment class just by understanding all the factors and all the drivers to the investment. Key apartment factors: highest risk adjustment returns, efficient cash distributions, wider availability of debt lowers our cost of capital or overall cost of capital. Rental housing needs usually expand as we continue to see the population grow. We see more people move into select areas, continues to put downward pressure on the overall supply that's not met, which continues to rise rates and rise rental rates and continues to bring up the valuations of overall properties. So, okay, we've talked about a lot of good things. Let's talk about some trends to watch, right? Been crazy out there. We've seen historical rent growth, seeing occupancy levels at all-time highs. Has to stop. Just like anything, we have to see it stop and moderate. Now, are we saying it's going to decline and have this massive runoff? No, but it may moderate, right? So we may see a slowdown, as we've seen right now, and a lot of banks want to come to the market or their terms are not attractive. Same thing we saw in COVID is everyone goes into a panic mode, banks included. And they go into a panic mode until they get used to the quote-unquote chaotic environment, and then they start coming back to the table. So there's banks right now that are getting used to the chaotic environment, and there's others that are still standing on the sideline. And when we see a lot of things continue with these events that keep coming up, we have the debt ceiling, then we have inflation, then we have rising interest rates, then we have war in Ukraine, right? There's so much information the banks are taking in, so they're trying to react. One, because they don't know the comfort level of their investment, and two, they're having a hard time understanding how to price their debt to put out to potential buyers of multifamily like ourselves. In the high interest rate environments, cap rates, spreads have compressed below historical lows, or we've seen a massive volatility in the treasuries, right, the 10-year treasury, and that's impacting our ability to make loans work. However, there's still lenders out there. Just because some lenders don't come to the table, the goal for me over the last 6 to 8 months, I've talked to as many lenders as I can, because two like-kind lenders will have completely different terms based on their threshold and their risk environment. So understanding all the tools that you have to work, again, empowers you to make the best decisions with your investments and how to source future capital for future investments. Rent growth's moderated, but we still see over last year it was 6 to 8%. I mean, historically, models in 2 to 3%. That's a pretty good day, right? So although it's moderated, where you had markets, you had a lot of the Southeast markets, the Florida markets between 15 and 20%, huge run-ups. That can't last forever. We're meeting workforce housing, right? They don't see what's happening here is their paychecks aren't keeping pace with the increase in rents. The rents caught up to where their paychecks were, started to pass a little bit beyond that, but they can't keep up with the pace, right? The FedExes, the Walmarts, these places, they're not continuing to increase the checks for these people here that are your tenants in your properties here. So we knew we were going to see that moderate. 2023 projected vacancy, 5.1%. That's been historical average. So although we were at 3, some markets 2% vacancy for a couple months, again, right? A lot of this was driven by the need of a lot of energy coming into the market here as we started to see a lot of the supply to pick up that was basically cut off in 2020 and 2021 to building. Now vacancy is just going to come back to our mean. And throughout 2022 and 2023, the 10-year treasury had been increasing and volatile. You still see it today with the debt ceiling finally coming to conclusion. We started seeing the treasury back off, but it's just been up, down, left, right, sideways. No one knew where it was going to go. It just speaks to the uncertainty that continues to exist in the market. But at each point, there's going to be basically some level of volatility and uncertainty. And we have to remember is we use the data set, we use the information to empower our decisions forward. Because at each moment of time, there's always going to be something that's keeping us or telling our minds that it's not the right time. 2020, 21, oh, it was COVID, okay. Next year, everybody wants to buy multifamily properties. There's no deals out there, but there's tons of money. Now, there's no money and there's the opportunity for deals, right? But what will be next year? To be seen. But if you can keep to your core thesis of buying great assets, meeting the need of housing demand, improving those properties, making them better places to live, you're constantly going to have a seat at the table. So with that said, what does this say for commercial real estate? Ultimately, as you talk to the apartment investing health, as long as the labor market continues to excel, you're going to continue to have viability in your product. Now, what this speaks to is that when we hear the word recession, we hear these other words, we're like, oh, recession, so it must be everywhere, rampant at the same time, right? Never happens like this. Each market, each state, each city, even various cities in various states react differently to the economic climate, differently to market conditions. So understanding your market that you're in and what's bringing you to that market puts you in the best place to perform today. Strong rent growth and low vacancy rates over the past 12 to 18 months continue and will continue to provide a financial buffer to you and your investments. Although we're seeing a moderation of rents, we are continuing to see rent growth. We're continuing to see elevated rents, elevated income on properties here that will be able to help us and hopefully empower the majority out there who've made good buying decisions through the next 12, 18, 24 months, 36 months, whatever it takes to bring the lending environment back to a calm nature. We're in a point of price discovery. We think that everyone thinks like us. And so if you're going out there to a seller of a property here, they may not have watched the news in 2 years. They don't know where rates are today. They're not going out there talking to banks. Maybe they've had this property 30, 40 years. But they hear prices have gone up because they talked to Johnny or Debbie down the road, 10 months ago, 15 months ago. So their mind of where their price and what their property is worth has not been affected to the nature of where it's affecting you on your buying decisions today with rates. But time tells. We have deals we're doing now that 12 months ago, guy was on the fence, they thought it was worth more, and they're coming to true because time tells the story and lets them come to a true decision where it is. So we're having a point of price discovery where prices are still elevated and haven't seen this huge trend off, and maybe we'll see a moderation, but I don't see a dip in our future, a huge dip in our future. However, from us as investors, as buyers, we're having to find the right opportunity with the right tools in place, whether it be from our equity or from our debt. So this price discovery is going to continue here. We'll continue to see this somewhere into 2024. Prolonged higher interest rates will increase cap rates. Yes, same thing. Cap rates, we see a lot of this in Class A. The difference between a $200 million property at a 4 cap that now would trade at a 4.75 cap is tremendous. So just a move in cap rates, and you're going to see a lot of this pressure come down from Class A where all the building is happening, is going to put downward pressure on BC assets, but be moderated because of continued need and a lack of supply. And we're going to see less volume, right? Less lenders on the table right now. So this year, we'll see lower volume. We had very, very high volume come in 2021, but a lot of that's because you just didn't have a lot of deals that could happen during COVID. So you had a lot of that push forward to the next year. So volume will be lower, but people are still doing deals. We're still doing deals. I know a lot of you in the room, are doing deals because you're making educated decisions on great investments that are going to have long-term viability. So we're going to continue to move the ball. So recession is a big word out there. However, you have to think about recession and then compare it to your market, right? I would feel much safer here in Franklin, Tennessee, or in Murfreesboro, Tennessee, than I would in a lot of areas over in Illinois, just what's just happening in the market. So if you think about that, you can no longer just seek recession as a big word. It just covers the entire U.S. And they're going to continue to just move the ball down the road because 2 quarters of just decline in GDP no longer signify or indicative of what they're going to call a recession. We're going to still hopefully get a soft landing. We hear these words, but maybe it would flip-flop or not. But again, as we continue to see the rates have to move because inflation continues to really just lag on us here. We talked maybe a month ago that they probably won't go to do any additional rate hikes. Now they're talking about rate hikes again. So we don't know where this is going to stop, and we're going to get to a point where it's either going to get us to what we want or it's going to break. I'm not going to be able to tell you which that is. But in that part, if you're finding yourself in good markets, you're going to be insulated to the need to put yourself in the best place to perform at your investments. The economy, confidence has dropped. You hear this all along. Gas prices up, food prices up, this is up, eggs is up. You hear all these things that are causing people to have strain on their ability to survive in today's climate. So the confidence is down. The news dynamic, of which a lot tend to make their decisions on, is fear and greed out there. So it puts people in a fearful state that's going to continue to put fearful recession, fearful spending habits. Right in COVID, we had 1 million people going a day, going to Home Depot, buying all this stuff to make their house, right? It's not happening today. People are holding on to their money, holding on to it for longer. It's going to mean that they don't want to jump out of their house, right? And they don't want to jump out of their rental because the cost of moves to rental. So he's going to keep people in houses and rentals for longer. and make them long-term renters compared to the need to say, well, today maybe I'll just jump into that house. Cost again to the house, the closing cost, everything else is going to keep people in their place. Federal funds rate, it's been a huge run up, right? More than a 7% chance of another additional rate increase it has, right? Going up 25 basis points into June. All the way back, we've gone up 500 points. I mean, historically, this is the fastest and highest it's gone in this timeline. And if we look historically again, this is usually comes down much quicker than it goes up. Well, we can't really think that's going to happen because in that pace, something dramatic is going to have to go out there and something real big is going to have to break. So instead of saying, oh, woe was me, how can we react and how can we succeed in this market today? That's the question we need to continue to ask ourselves. Long-term debt, fixed rate, reserves, cash flow. If you can find lenders, you can work with to meet that need, you cannot fail. Put yourself in good assets, desirable markets. You're going to be in the best position to perform each and every day with you and your property. Growth rates of select opponents over inflations here, as we talked a little bit about this, but just things all over the course of the map that are continuing to keep inflation high. And that's going to continue to move. So instead of worrying about each and every driver, realize we're in a point of time. If we make good investment decisions that you're here today at Multifamily Live, learning how to create more value in your earning potential, your overall net worth. You're not here for the day-and-day reaction. You're here for the long course of what you're going to do, not only for yourself and your family. So we can look at where things are at as a good test case for what's happening out there in the environment, but make sure we're putting our investors, our renters, our properties in the best condition to continue to perform. Inflation tame, right? So June of 22, we say it peaked 9%. That's pretty high. We've seen 500 basis points back since 2022. Highest bring up since 2007. A lot of things that just have been highest since, but historically here, we're going to moderate ourselves. Prime's at 8.25 on average. If you look at the rolling 10-year average on prime, it moderates at 5.5. So although we're high now, this is an environment where rates will continue to moderate and we will find our place back. The question is when. Lingering inflation, bank failures, debt ceiling, rising rates. It's put the 10-year treasury in flux, in chaos. It's put lenders on the back burner trying to ask themselves, how can we put product out? Because lenders want to lend. They put money out there, they make money on lending. They don't want to sit in the sidelines. They don't want to sit there and say, I can't lend to you. They want to lend. They're just having a hard time figuring out how to lend. And their ball keeps moving for them and their team as well. Home prices continue to squeeze on rent, right? Fewer listings. Even though houses now and interest rates have gone up, people are saying, well, shoot, I have a 2.8% mortgage. I'm not going to move because if I move, I'm going to have a 7% mortgage. So I'm going to stay in my house. So the houses that do come available, they're hard to get the value to come down because there's not enough supply. There's not enough housing. So those people that potentially want to jump in a house, they can't find that house again. They can't afford the house. So they're going to stay renters. Buyer demand has outpaced supply in March. Surging mortgage rates may dampen home sales. The rate for the 30-year mortgage is over 7%, according to Mortgage News Daily. P&I cost for homes raised dramatically. Not only is your inability to have the buying power been limited, but your overall cost for having a home has been dramatically cut. P&I costs, again, as you see the acceleration right here, look at the cost to own a home compared to the cost to rent. It's going to keep people on the sidelines. This empowers 75% of the nation. Their net worth is in their home. 75%. So people want to become home buyers, but there's not the ability to. They can't meet it. So their choice is they're going to save the money they have because they can't afford a down payment, they can't afford a mortgage payment, but they can't even afford the closing costs and all the additional elements to having that loan, nor have the credit worthiness to get into that house at the cost of where it stands today. So they're going to stay renters. Want to be home buyers, will stay renters for longer. How does that help you as the investor? Two of the biggest factors to your investment is your vacancy and your turnover cost. So if you have good renters that will stay longer, that are going to pay more rent because even if they wanted to move around town, it's going to cost them a couple $1,000s to move, and there's nowhere that they can move for cheaper, and you're providing the best housing in the area. So they're going to choose to stay renters for longer, what's going to help to accelerate the performance of your property and moderate your expenses and your overall capital expenditures. So we've seen rent changes here, see a lot of effective rent changes as we continue to grow. A lot of growth is going to continue to happen. Even with moderated rents right now, you still have rent growth. And even if the part that we talk about, decline in rents, it's still elevated to where we've seen this historically. Trends to watch for affordable housing. Affordable housing meets a specific need. It's a specific need of a big need here in America. 7 million low-income units needed for demand. We have about 640 that are scheduled to expire. What that means is that buyers or owners of this affordable housing no longer have to keep to the threshold of potentially the area median income to provide this housing for a tenant that's basically in need. They'll be able to take this and meet the market, move these rents up, so it's going to continue to put so much strain on the market of need of affordable housing. Annual multifamily absorption, we finally saw this year into next year, we're going to meet the year-on need. Regardless, we're still not going to meet the need, the overall need for the quarter, right? We need 16.5 million homes. We're going to build between 10 and 11. So if we look here on the overall course of the decade, we're still not going to meet the need, or even if we see the absorption in some of these markets. And these are some of the bigger markets, right? You see your Phoenixes, you see even here in Nashville, you see there's a lot of driver markets, a lot of building. There's need in most all markets, especially if they have jobs, job growth, and job demands. Employment growth. Continue to see employment growth, continue to see a part. You see tenant for having employee retention here. People want to keep employees, good employees for longer. It's hard to find good talents that are going to pay them more, which continue to help to accelerate for good properties the need to rise your rents. Growth income in a lot of markets here. You see some of the top 10 on the left and the bottom 10 on the right. This is year on year. These continue to trend, they continue to forecast, where you see a lot of the Southeast on the left, some of the Midwest on the right. The thing about the left and the right here is the Southeast have had more overall growth, but could have potential more of a decline, where the Midwest continues to trend at just ho-hum, nothing to see here. 2-3% growth, 2%, 3% appreciation, time over time. Okay, got 2 slides here left for you. Multifamily fundamentals recap. Expect growth in the fundamentals to accelerate this year just because we had so much run up over the last few years, and just the lack of lending is out there. Forecasts show vacancy at 5.1. Honestly, 5.5 is where we've seen it over the course of many years. So nothing to see here. We're just getting back to a true nature of where these properties should perform at. If you're at 100% occupied, well, you're probably not charging enough for rent. Simple as the case. 95% is always a good number to underwrite in the right markets right here, because it means that you're constantly testing the market and you continue to see growth, and you're in a good market where rents are going to continue to grow, so you're going to continue to have loss to your ability to get the lease amount that's market leased. Reach reports have grown on average 3.9%, same period between a great financial crisis and the pandemic. Rent growth 3.6 to 6.1. So we're still in that range of seeing consistent growth in our properties here. Now we just have to track with where it's going in inflation. And if the Fed gets a soft landing, we'll see consumer confidence come back. We'll see more people out there wanting to get into more housing. We'll see more development activity, and we'll see more energy coming back to the housing market, but it'll also bring more money and a better lending environment. So no matter which side you fall here, you can win in the multifamily side. Increased pressures on multifamily cap rates and valuations. So this is where the price discovery is going to come. As interest rates stay higher, prices will have to lower to allow more activity into the market, especially as you see buyers of multifamily in the last 2, 3, 4, 5 years with their loan terms coming up, and when they reprice these deals, they no longer make sense for them to keep, and they're going to look to add or gain on the valuation they've created by selling the property, but it won't be at the peak prices that they saw in 2021. So it's going to take a couple months for this price discovery. Give it time, understand your product, have a business plan that we're going to talk a lot about and help you formulate here to be able to commit to the right deals when they come along so you can make the best buying decisions. We see here, this is your cap rate spread versus the Treasury. Historically, there's always been a healthy spread, but now if you see this year, we have the smallest spread we've had over time. So what this says, it's hard to get deals to pencil until the Treasury figures its way out and creates calm and stops all the chaos or the volatility we've seen out there. Conclusion here. Trajectory indicates the multifamily industry on track for a healthy 2023. Why? People need a place to live. Simple as that. Couple that with people need a good place to live, and you're constantly going to have a need to be able to provide great housing and to provide a great investment for you. Rents are expected to remain positive but continue to moderate. Again, speaking globally here, speaking across the nation, your markets are going to drive your potential. Being in good markets with jobs, with reasons for people want to be there, you're always going to have a viable solution, especially if there's a lack of supply. Vacancy rates will really moderate, 5.1% as we talked about. Volume will be muted with interest rates as banks continue to see it, but people are still doing deals. Still see deals coming out each and every day. People are still selling, lots of reasons. They've increased their value. They've met their marks. Time to return money to our investors. Their loans coming to an end. There's always buyer and seller demand. Find your markets where you want to be. You will have potential to perform here, and we're going to help you do it here. It was the next few days. Put yourself in the right position to perform. Timing will determine how strong the multifamily market will be, right? Continuing with the job market. Job market is going to drive a lot of this. And lastly, tailwinds will help prop up the multifamily market in the long run. That's our continued growth of just economic growth, of just the accelerated rents, just where people locked in debt the last few years, right? So a couple years ago, it made no sense to assume loans. Now there's a big nature. We can go out there and find assumable loans that are great terms. So you stand here today, or you sit there, and I'll stand here, right? Think about where you stand today in terms of your business plan. What can set the course and trajectory for you, and how multifamily is just such a fantastic business class for you, asset class for you to perform with, that can set the stage to take growth in you and your future. Thank you very much.
Hey, what's going on? I hope you guys enjoyed that. I was sitting there just taking notes as well, because I always listen to Jason when he gives his insight into the market. Ton of data points, pushing hard onto why multifamily, why now. We have a couple presentations left. I appreciate you guys hanging on with us. For those that have stayed into the afternoon, the next presentation is going to be me talking about owner financing. I've gotten a lot of questions about seller financing. Now is a very popular time to be making creative offers. I don't want to talk too much about my actual presentation, because I'm going to obviously go into it for the next 45 minutes, but the people who are making creative offers over the next 12 to 18 months are going to be really the ones who can win in this economic climate. Being able to leverage sellers' equity and roll it into the deal is something we're offering pretty much on every deal that we come across right now. So pay attention to the next presentation. It is going to give you some ideas to look and think about deals differently. I'm telling you, if you can start to think about things creatively and not think, hey, I can't pay that price, but instead, how can I pay that price? That's my goal for you guys with this next presentation. I'm going to talk about owner financing, held debt, promissory notes, first position liens, second position liens, master lease options, subject to loan assumptions, all the creative stuff that we're doing to still buy properties right now when we can't go to banks because 7% debt doesn't make sense. So the next one's going to be really good. And then I'll answer any questions. If you guys are asking questions and I'm not answering them live, they are being recorded into the sheet. And then at the end, I'm going to just hammer some Q&A for y'all. So stick around for that. And now I'm going to get into owner financing, commercial real estate. Master this stuff, and you'll be very, very dangerous over the next 24 months. All right, we're doing creative financing. Talking about the different types. I'm going to show you guys an offer that we typically make with a couple different variations of how we get money to the seller and why it's beneficial to the seller. I'm going to show you guys a bunch of different stuff. So we're gonna go. All right, I'm going to write something down, and you guys need to write it down too. Can't have both. It's one or the other. Their choice. It's my price on your terms, or your price on my terms. Up to you. But when I'm looking at deals with sellers, It's one of these. Either I'm going to get it at a price that I need to buy it at, and I can close whenever you want. I can close on mostly, for the most part, your terms with the earnest money you need, everything like that. But if you have a price and I can't get to it, then I'm going to be able to get to your price on my terms. And this right here, the people who can structure deals creatively are going to excel over the next 24 months. The people who can explain how they can get money to the seller and get them their price creatively, those people are going to win over the next 18 to 24 months as we weather the storm that we're in. As we are the buffalo pushing through the storm, you need to be the creative buffalo that's structuring deals different ways in order to get through this, because we are in this little gap. Sellers still have that kind of pricing expectation that they had in 2021 when interest rates were 3.5%, 4%. They haven't quite come down, but we're definitely not in a seller's market anymore because of where interest rates are. Debt service is twice as much, but we're not quite in a buyer's market yet because prices haven't really adjusted. And I don't see prices coming like way back down on a price per unit standpoint. So look, there's this gap, right? So what are you gonna do? You're just gonna sit on the sidelines and not buy any deals? Or are you gonna figure out how to close that gap? The goal of this is, for me, is to help you guys creatively close that gap, okay? Before you do any of that, I think you have to understand from a creative offer standpoint when and where it's applicable. So that requires a bit of tactical empathy. It requires the ability to ask Socratic questions and figure out if the solution that you're about to provide is even the best fit for the person that you're sitting across from, okay? These deals are not the best going through a broker. Like, I've had struggles navigating creative offers when I'm trying to negotiate through a broker. I always prefer to do it with the seller. And you guys will hear me, some of you guys have heard me do this live, but like, I will always ask the broker to talk to the seller, and like, I'll bridge that call and like say, hey, you can be on the call. But if I'm gonna make a creative offer, I wanna be able to explain it to the seller directly. I just have trouble getting through. So don't be afraid to do that, because a lot of times, when you just make an offer to a seller that owns an apartment complex, and let's just talk about a specific avatar, maybe they have some equity in it, right? And you just make them a straight offer. I am gonna pay you $5 million, okay? Maybe they have $2.5 million left on the note. They're taking $2.5 million off the table. Maybe their basis was $3 million. You've just given them a $2 million tax problem. And if they're in just a 30% tax bracket, they have a $600,000 check that they now have to stroke to the IRS, or they have to go into a 1031 and identify another property. And it has never been harder to find a good deal that gets them similar returns from the current property that they have. Okay, so you're giving them a problem. Why not give them a solution? Why not present them with a solution to the problem that they're already knowing that they're about to have? So that's what today's about. I want to give you guys some ideas to help you present some solutions. Does that sound good? Okay, before I do that, I want to show you guys a video. Now, I put together this video. I used the word avatar a couple of times because I like to define the avatar, because you have to define who creative solutions will work for in real estate deals. And before I show you this video, the 3 to 4 types of creative offers that you can make. Number 1 is seller carry in the first or second position. So I'll go through what that looks like, but the seller can either hold a first position promissory note and essentially be the bank, or they can hold some sort of second position debt above the lender in a second position that's personally guaranteed or guaranteed against the property, okay? The second type is subject to. We talked a lot about loan assumptions. That's the second type. Now, I like to get them to carry a second on top of the loan assumption, but that's the second type of creative offer. The third type is master lease options. You guys have ever heard of a master lease option? It's when essentially you just sign a master lease for the building and then you sublet to the tenants with the option to purchase at an agreed upon price. I've never completed a master lease option. I've made a couple offers. They're beneficial in some scenarios, but be careful with master lease option. And then the third one is equity holdbacks. So we've really been working with some sellers to allow them to participate in the upside, get some depreciation, and work basically as a partner in the property and less as just a debt position. So those are the 4 types that we're kind of working with. They only apply to specific avatars because you have to have equity in the property in order to leverage equity to get seller financing. If the people just bought it in 2022 and they're max leveraged and they're trying to get what they paid for it, they don't have any equity to work with. You really can't be too creative, okay? But the more equity they have, the more creative you can be. So in my mind, my avatar was, the baby boomer, 65, that has owned this property. Maybe they're self-managing. They've had it for 12, 13, 14 years. They bought it in 90s, 2000s, and they've owned it. Maybe their kids don't want it, but it's that avatar.
is who I'm trying to get because they're perfect for this type of property, okay? And the only problem that we have right now is those avatars are holding on to the assets because of the financial storm that's ahead. They don't have any alternatives. It's that whole problem that I was just telling you about. You guys make them an offer, it just creates a problem for them, okay? So we need to get in front of those avatars. That's the struggle, direct to seller. How do you go direct to seller to get in front of those avatars? And how do you get in front of them enough to pique their interest to then reach out to try and get some creative offer in front of them? So the reason I'm going to show you this, guys, this video is because I want to open up your mind to start thinking about deals creatively and thinking about deals like, it's not that I can or can't get it done, it's how can I get it done? You can pay any price on your terms. You can pay any price on your terms. So you need to start thinking, all right, how can I make this deal work? Whenever either one of my guys comes into my office and they're like, hey, we can't make this deal work, I'm like, what are they asking? And Tahal I got a deal from Tahal over there, and he was like, he was at 2.3 million cash, and he's like, the guy said he won't come off 3.2. And I was like, let's get him 3.2. And we sat down and we figured out how to get him 3.2 million, right? And the cash offer was at 2.3. So we figured out how to get him 3.2 million. And it was just done how I'm about to show you. But I want to open up you guys to kind of the mindset around the avatar that I'm going after so that you guys can see it and start to recognize it. And then also, I think this will help kind of explain it to some of those people, because the creative financing thing is kind of like this. It's kind of like this term that gets thrown out there, but it's really kind of an intricate term. And it's like, I describe it as like this cake. But I want to explain the ingredients of the cake, because you all hear about owner financing, seller financing, boom, boom, boom. That's the cake. But how do you make the cake? What's involved in the cake? What are the ingredients of the cake? That's what I'm hoping to share with you guys. You can run that video.
Do you own commercial real estate and have thought about selling? You've probably considered the trade-off you're making. On the one hand, you're in the fortunate position of being able to sell your asset for a sizable gain while walking away from the day-to-day hassles of ownership. But that's only half the story, because you're also going to be on the hook for the capital gains tax. And the cash flow the asset is providing, that's now gone, which means you must replace it by finding another vehicle providing the same stability as real estate with similar returns. And that's never been more difficult. What if you didn't have to make that trade-off? What if you could retain many of the benefits of ownership, like the cash flow, capital preservation, and equity growth, but eliminate the headaches that come with managing the buildings? That's what we help owners do at Titan Capital Group. Titan Capital Group is the only real estate acquisition company that allows sellers to continue to participate in the upside of their assets while taking the hassles of management off their plate. Our ABC offer process helps you mitigate gains tax, lets you continue to participate in the upside of the asset, and brings you distributions at a preferred rate of return, all while eliminating everything you don't enjoy about property ownership. With the ABC process, you can choose between 3 options to sell your asset. Option A is the traditional way to sell that you're familiar with. Options B and C are more creative options that allow you to retain upside equity in the asset and cash flow with no headaches and little downside risk. Sound interesting? Call, text, or email us today for a full breakdown, and let's explore whether an ABC offer from Titan Capital Group makes sense for your property.
Not bad. Not bad. That's not my cell phone, so don't blow that number up, please. Track that thing. So that's kind of that's the ABC that I'm telling you guys about. And as you guys saw there's a lot of things that we try and get the seller to start to wrap their head around, like, man, I get to participate in the upside. I get distributions. A lot of times we can pay them more money on interest from the equity than they're typically making on their current net operating income for managing the asset. So like we can get it to almost be a budget neutral decision while taking the headaches of ownership off their plate, right? So there's a lot of different ways we can creatively do this. You guys can go to the screen share. You guys want to see like a couple ABC's offers, like how we put them together and how we structure them? Is that cool? Okay. You guys can go to the screen share here. So when we put together an LOI, we like to give, like I said, a few options here. So this is what our typical LOI looks like. It has purchase price, it has some earnest money, has a closing timeline, and then it has 3 options here. So these options are sort of spelled out, and I don't need to go through them here because I'm going to go through the math, which is the important thing that I want to go through with you guys. But it tells the people that the 3 options and sort of explains the interest that they're going to get. But the most important part, I think, here, and one of our group members, David, like put this chart together, and I was like, this is amazing. Like, we're gonna start to really put this chart in each one of the LOIs. And if you notice, this property, 2.3 million, I'll go through and show you guys just the analysis of it. But this is a 40-unit property, another one in Birmingham. This is a 40-unit property. 2.35 was the best we could do on cash because that debt service is so high. That's the reason that offer is so much lower. I'll zoom in for you guys. I see some people taking photos. Now, option B, 2.8 million, we can pay them a little bit more money because now we're only having to put, like, they're carrying some paper. So cash paid to seller at closing is 2.3, and then they're holding the difference. So the difference of like 575,000, they're holding that 575 in a second position note, and they're getting 6% interest. Let me look at this, make sure I'm telling you guys the right thing. And they're getting 6% interest, 474,000, and they're getting 6% interest over a 7-year term. This one had Tahal put no payments in there for the first 12 months. I like that, Tahal. So if it's a reposition, you can do deferred payments, which means you kick them at the end, or you do no payments. And then you get total principal and interest. And then this is where the option 3 is where the seller holds some equity. So in this one, what they're doing is, and this is just Tahal's that he sent me. So 2.8 million, we're putting 1.7. So we'd go to a bank to get the initial loan. 1.7 is going down to them at closing. That's funded by the bank. And then basically the seller is the equity position in the property. So I don't have to go out and do a syndication. I don't have to go out and raise money. I'm just rolling the seller in as the equity investor. Now I have to keep them under 19% ownership so that they don't have to sign into the loan, but you can leverage the seller as your equity investor in the property. Now, why is that cool? Well, if they own the property already, they obviously believe in the location. They obviously believe in the asset. Now they just have to trust you that you're not going to screw up the building. Like, you're not going to screw it up, right? But if they trust in the asset, they trust in the location, they already understand real estate, they understand cash flow, they understand appreciation, they understand upside. It's kind of an easy sell, right? I'm just going to get them to just roll some equity. Now they're getting some money down because it's very difficult to just do zero down. Like, they got to get a little taste. They got to get a little something. But then if you look, I mean, this is a pretty healthy annual number. This is paid out in quarterly distributions. They're holding $1 million as the first position. Not first position, they're holding $1 million in equity position. So this option 3, they're not in a second position promissory note that has to get approved by the lender or anything. Typically, large second position promissory notes are not going to necessarily get approved by the lender. They want to see that you have some skin in the game. That's why we typically will have an option where they hold a little bit less, and then an option where they hold a little bit more to give them and let them make a decision. Remember, my terms, your price, my terms. Do they want a little bit more down? Do they want a little bit less down, a little bit more interest? Do they want higher payments? Do they want a shorter term? All the things about like, you can negotiate, like on a terms deal, right? There's so many, the reason I like terms deals is because there's so many different things to negotiate. This is your balloon. Is that how you spell balloon? This is your, did I spell balloon right? You know when you write it and it looks weird? I'm like, did I spell that right? Misspell balloon in front of 300 people. That'd be cool. You got interest rate. You can get, IO. You get deferred payments. I mean, there's so many different things. I mean, I'm even missing a few. Like, there are so many different things that you can negotiate and press on. The down payment, right? So when they press here, I'm going to press here, right? When they press for a shorter balloon, I'm going to press for lower interest. When they press for, a higher down payment, I'm going to press for more IO. Like, I can press. So this is what we do. Now, on option C, I want to just continue to explain it. So the reason this year 1 is a little bit less is because it's prorated, right, to whenever we close. And then the annual cash flow is coming in. So they get to see exactly how much money they're going to get on a preferred return basis. And then this is the amount that they would get, which is their equity position plus their accrued interest. So this is the way that I do it on my offers, and I would recommend you guys do the same. You don't want to burden your debt service, because if they're in a debt position or a preferred equity position, you don't want to burden your property with so much leverage that you don't have any free cash flow available to fund operations, things like that, and send money to your investors or yourself. So what I like to do is like, let's say that I'm paying them 6% interest right now. I like to do a 3%, it's called 3% simple interest, and then 3%, it's called PIK. So this is paid at the end. So a 3% simple interest, and then 3% paid at the end. So the reason you see, this is at 6%, but the reason you see 30,000 on $1 million held is because I'm only paying them 3% annually, and then 3% is accruing, and it's gonna get paid at the end. So the reason that $1 million note is 252 is because I've been accruing another 30,000 in interest that's paid at the end, because that doesn't burden my property during the years of ownership. I can go ahead and accrue that and just pay it when I get at my exit. Does that all make sense? Raise your hand if you're tracking me. Is everybody tracking me on this? Am I going way over anybody's head? Please raise your hand if it's a little over. Everybody's tracking. Okay, I'm trying to simplify it. It's, again, I think the video and everything is, it's complicated, but it's also very simple when you understand the concept of it. It's very simple. This other thing, profit from sale based on upside. So when we give them, this one's 15% of the upside, which is pretty high. We're usually between 5, 10%. Sometimes we'll go 15. Now, the upside in the property is what we use. This is that deal that I was telling you guys about where we had to get him, he was asking 3.2. So we had to kick the upside in the property up to get him over that 3.2 number. So we got him to 3.2. You want 3.2, we'll get you to 3.2. You just got to be patient. And if they have a little patience and they're that good avatar, like, you can get them their number. I got you your price, or this is my price. My price, close in 60 days. Your price, my terms. And then we also give them, so I'll explain this on the analyzer. So for those that use our analyzer, I'm going to show you guys kind of where we plug this in, because we update our analyzer every quarter. And Jason and I go back and we try and break it and refix it, because now we're starting to do more of these creative offers, but we have to have the ability to analyze them that way. So I'll show you guys how we put it in here in a second. But profits from sale based on upside. So that 15% that they're getting on the upside, after I pay back my debt service when I sell, my loan, my mortgage, I pay off my mortgage, I pay down my preferred return that I have into any investors, I pay back all the principal that I have to my investors, because there's still going to be some LP investors potentially. If you have to fund CapEx or anything like that, there still might be some LP money. So you're going to pay back all that stuff. And then above that is your profit available for distribution. So they're going to get 15% of that profit available for distribution. So, I mean, that number must have been like, 1.5 million profit for distribution, and they're going to get another 230. Now, this is all approximate, and it's explained to them that it's approximate. These are based on our projections. This is what we're planning on doing. Now, this is the other thing that's pretty cool. You can give people depreciation. So you can give them, based on that $1 million, you can give them depreciation to offset the $1 million that they took off the table. So they're going to get 1.7 million cash paid to seller at closing, depending on what sort of tax burden they have or what their basis is on that. They're going to take some cash off the table and have to pay taxes on that. So if you can give them the $1 million that they're leaving in, they're now going to get depreciation based on their ownership of the equity for that $1 million. Now that $1 million, if we do a cost segregation study, who knows is kind of what the cost, everybody familiar with cost segregation studies, right? They just went down to 80%, but it's still pretty good. So they took out the 100% bonus. They're down to 80, still really good. Typically on $100,000 invested, we're typically seeing between 40 and 60% is the dollar for dollar depreciation that people are getting on $100,000 invested. So I'm very conservative when I make my estimates to my sellers. But if they're doing $1 million, typically they're going to get $400,000 in dollar for dollar savings against their taxes. So that helps them with the 1.7 million that they took off the table, assuming maybe they had, if they had $1 million gain, I'm wiping out almost half their taxable burden. And the reason it says this on the, I'm going back and forth, so the screen's going. The reason it says 100,000 is because I'm just estimating, again, very conservatively, that they're in the 25% tax bracket, so that they're getting $100,000 of basically, that they don't have to write this much to the IRS. That's going in their pocket. They're saving $100,000. So that counts towards the money that they're getting. Does that make sense? You tracking me on that? That counts towards it. So that's how we get them to their number. Yeah, so that's one LOI. Now, again, you have to sit down. I prefer to sit down and it has to be the right avatar, and you have to sit down and explain this. And when you just shoot this to a broker, a lot of them can't wrap their heads around what you're trying to do. But it's a great solution for a lot of folks right now that don't have alternative investments. You give them this $2.3 million and they go pay off their note, and then they have $1.3 million in the bank. It's a problem, tax problem. It's a redeployment problem. Savings accounts are like 0.01% interest. It's getting printed away like crazy by inflation. So stop giving sellers problems and start solving their problems. All right, let me show you guys how this looks on an analyzer here. So for the people who are familiar with this, if you're not, you do need some sort of tools, right? Because you can do the back of the napkin math, but when it comes down to actually getting these deals closed, I recommend you do have some sort of tools to help underwrite. This is a 40 unit. So the update that we made here, and I'll show you guys where I get these numbers, because you're probably thinking like, hey, are you doing back of the napkin math to get these numbers? The answer is no. What I'm doing is I'm putting these sellers, this preferred equity summary here. So I'm toggling this on, and I'm putting these sellers in a preferred equity position. So basically, they're basically like mezzanine debt above the leverage from the bank. So they're going, preferred equity position is on. Over here is the $2.8 million purchase price. They're going to hold 85%, which is the $1 million. So I still have to bring 15%, but I only have to raise $177,000. Can you guys raise $177,000? Is raising $177,000 a little bit easier than raising $1.2 million? Okay, this is how you raise $177,000 and buy a 40 unit versus having to go raise $1.3 million and still make the deal work. And let me look at the returns here. So these are the returns. Someone say, "Ooh!" So these are the returns for the LPs because there's so little cash to be returned. And then these are my deal level returns. So a little shy on the IRR. Average annual return is just shy of 14%. I would like to get this to a higher than a 2x multiple and a 14 IRR, but cash on cash is pretty solid from what we're seeing. Now, the place that you find this data here is over here on the annual pro forma. So I want to look at my property from an annual basis and see how this thing performs. This is the most important tab because it's a snapshot of the next 7 years and how this property is going to project out and look. Okay, so I got my gross potential rent at the top. I got my vacancy in there. I got some RUBS income, some other income from laundry, pet fees, things like that. I got my controllable expenses. Jason and I will go through some profit and loss stuff here in a little bit. This is more about creative financing. I got my total expenses close to 40%, kind of what we talked about yesterday. And then I got my net operating income. So my net operating income is covering on my debt service coverage ratio just shy of 1.5. That's a pretty healthy deal. Right? Debt service coverage ratio is the number you really need to pay attention to. And to me, a very healthy debt service coverage ratio right now is 1.5, right? 1.25 is really what the banks won't touch anything sub 1.25. But you got to pay attention to your debt service coverage ratio. Yesterday, when I talked about stress testing, when you start to mess with this number, this is what you need to come back to and start stress testing this DSCR, right? Because I need to know where my I'll just do it. I'll just show you guys. So if I go down to my occupancy and this property goes 30% vacant, vacancy loss, this property goes 30% vacant, I'm underwater. So on a 40 unit, what's 30% of 4? 12. So if I have 12 people move out, I'm not even covering my debt service. Now, what I would do is stress test it. So, all right, 25%? It's 10 people. If 10 people move out of my building, or not even move out, just stop paying, I'm losing money. It's scary, a 40 unit, you just got to know that, because now when you start to see vacancy come up or you start to see economic vacancy, like, damn, we got 6 people not paying, like 4 more if we ain't covering. So it's good to know where those numbers are at. I just want to share that with you guys. So now, where the preferred equity comes into play, when it comes to the sellers, right? My whole gig up here, guys, is to help you acquire more properties. So when I did my whole acquisitions yesterday, how to find them, where to find them, how to talk to them, things like that. Now this is about how to structure them in order to get them to closing. This is where your preferred equity is coming into play here. So the proceeds that they're holding back is the $1 million. You guys saw that in the number 3. And then every year, this is the $30,000. And if you guys look, I'm flipping back to the summary and assumptions tab here. This is the 3% and then the 3% paid and accruing. So they're holding the $1 million, and then the 3% is every year getting paid in simple interest. And then at the end, this is it accruing. So at the end, they get the 125. Okay. Everybody tracking me on that one? You guys tracking me on that deal? Do you guys see how I can get him the 3.2 he's asking? You guys see how I closed $1 million gap? It was $1 million between the A offer and the C offer was $1 million. And I'm still like, maybe this thing needs to go down to like 2.7, but I'm still like hitting all my, look at those LP returns. I mean, that's a 23%. I'm going to take some more equity for the GP there because I really like to retain as much equity as possible, to be honest with you guys. Sorry for my LPs out there, but I'm going to keep as much equity as I can while still getting you a 15% IRR. But then I go in there and I'll start to play with this. I'll go in there and start to play with my amount of equity that I'm going to retain as the owner, as the GP. So maybe I have 60% right now, and I can take 70% of this deal as the GP. And let's see what happens to the 200,000 that I had to raise from you guys. Still smoking deal. I might not even give you guys equity. I might just give them a little pref, right? So that's one of them. You guys want to see another one? You guys want to see another one? All right, so this one is 186 ETH. You remember this one, Tal? This is did you get this deal? No? Okay. So this one, a little bit different here. So the cool thing is like you can really do kind of whatever makes the numbers make sense here. So this is a little different one, a little bit cheaper property. I think this one's like a 12 unit. This type of, I'll zoom in here in a second. These type of tactics work really well for like sub 100 units, really well for sub 50 unit properties. Again, it's when you can get these direct to seller stuff. So 800,000 is the price we could pay. I think this guy said he wanted 1.5, so we tried to stretch him and get as close to 1.5 as possible. He's paying 200 here. He's getting paid 200 here at closing, and then he's holding an $800,000 note. That 800,000, I think that's at 6% right there. So 48, and then he's getting $1 million here. So he's getting almost 400 grand if he's willing to be a little patient, an extra 400 grand if he's willing to be a little patient. On this one, he's holding just shy of 300,000, 340,000 here, and that's his interest that he's getting on his money. And then he's getting there's his cash paid to him, profits based on the upside, and there's his depreciation that he's getting. I think there's an LOI in here for this one, or there's some underwriting for this one. So let me look at this one on the underwriting side to see where this is coming in. Oh, that's way too small. So I think on this one, you can also put him in a first position here. So for those of you guys that are looking to structure these things, like you can put him in the main leverage position as the first position in this column right here, or you can turn on that preferred equity and put him in the second position, like I said, in that preferred equity column. So the same thing though, you're going to go to the annual pro forma tab, and if the seller is in the first position, then what you'll do is you'll find his annual payments right here in the debt service. He's essentially the bank if he's in the first position as the bank, and if he's in the second position, that's where you find him in the preferred equity column. Okay, still always keeping an eye on that DSCR and always keeping an eye on my returns and stress testing the heck out of my returns. I think the other one we had here was a bigger deal. So this one is at 148 unit. So just so you guys know, this works on the bigger stuff too. John, this deal is yours up in Clarksville, 148 units. Who likes Middle Tennessee? People investing in Middle Tennessee. This one's up in Clarksville. I think this one's actually, this guy is, I remember correctly, this guy's pretty close. We had to bridge the gap from the price he wanted. But what we did was he's holding almost $3 million. He has a lot of equity in this thing. So he's holding $3 million note. We're going to a bank to get the first position loan at 6.15. And then he's got a preferred equity, same thing, 6% on the preferred equity side. And on the annual pro forma, DSCR looks healthy. And if I go down to his preferred equity, I think this guy's actually making more money on the proceeds annually from his position held than he would if he than he was making currently owning the property. So 86,000 a year is what he's getting paid, and then this other 86,000 is accruing to get the 3.5. And I think the LOI went out. He was asking like 18 million. Our cash offer was like 14.5, and we were able to get him to 17 17 million with the creative offers. So it's got to make sense. Always stress test your exit. This is where I really want to, I told you guys about stress testing your cap rate. So these gross sale proceeds from your exit, like I think this one is a little bit high here. So 17 million on the entrance at 114 a door. And then John's at 162 a door on the exit. I might come in here and I might mess with John on the exit here and just say like, hey, well, what if we, Clarksville, I don't know if it's going to appreciate that much. So maybe Clarksville comes down to I bring them back down to like a 140 a door, 155 a door. Maybe I'll just stress test it at 140 a door. I'm not going to take it down, 142 a door, right? And it kills my returns. So you see how I'm kind of playing with it? That throws my returns off, where at 160 a door, it looks great. But what happens if I can't get 160 a door? I got to know that. I got to know that information. So that's what I got for you on the creative offers. I just want you guys to think about this a little bit differently. I want, if the situation permits, I want you guys to at least be trying to make, it doesn't have to be A, B, C. Like it can be A, B. You can just make give them one creative option. But you guys need to put something together that helps bridge the gap between what they're asking and what you can actually pay. Because the people who can do this over the next 18 months are going to really win. And I appreciate you guys. I'm trying to think if I have anything else. I don't want to forget anything on this stuff because it's really, really important. But the last thing that I'll say is when you're trying to explain this to a seller, like I get a lot of pushback when I hear people, because I always record my calls and I have all my people record their calls, and they get a lot of pushback when your first question, you get a lot of pushback when your initial statement is like, hey, are you open to owner financing? 9 times out of 10, it gets met with a brick wall. If anybody's ever said that. If you say it to a broker, they're like, nah, they're not open. If you say it to a seller, like, I don't want to do that, right? But when you lead with the benefits, that the whole reason I put together that video, or you lead with the benefits, hey, have you ever thought about a solution that could still allow you to get upside in the property, help you with some of the tax hits, tax implications that you're going to have, still get you some cash flow and eliminate the headaches? Have you thought about a solution like that? And 9 times out of 10, they're like, no, I haven't. Well, if I could put together an offer that did those things for you, would that be something you'd be interested in looking at? Yeah, it would be. Okay, this is when you sit down with the ABC offer. Okay, I have like 5 minutes. Does anybody have any questions about the ABC offer, about the financing? I got some questions. All right, look, can we go to the mics real quick if you have a question? I got 6 minutes. I want to make this super clear because it's important.
I just
want
to see if you can go back to the page that you were writing before that, so I can take a picture because I missed
of
it.
Of this thing?
Yes,
This one?
that one. Thank you.
Yeah, sure.
Master lease pitfalls. You said, because I've been trying to float this to a couple sellers. What are the pitfalls? What are things I should watch out for?
So on a master lease option, you are signing an option to purchase the property in, let's say, 2 or 3 years after you stabilize it, right? What happens when that seller sees what you did and decides that he doesn't want to sell it to you anymore? You can either sue him or punch him. Those are your options. So the downside for me is I don't have ownership of the building. I just have a master lease, but the deed is not in my name. The deed is still in the seller's name, and it's a promissory note to sell me the property. 2 years is a long time and things can change.
Yeah,
I'm not saying stay away from master lease options. I'm saying be careful with master lease options because they require a lot of trust. Because these require trust, but at least I'm getting the deed. I want control. Sure. Master lease, I like control. I'm a big control freak. And with a master lease option, you're doing all of this work and you technically don't have control of the deed. So just be careful. They can be super lucrative deals.
Right.
And you have to have a lot of trust that in 2 years, when it comes time to execute that purchase price that you agreed upon 2 years ago, they're not going to say, well, hey, listen, that property's worth a lot more money. And you're going to say, no, I'm the one who got it there. And they're going to say, yeah, but I think I want a little bit more money. Just be careful. You can still do them. Just be careful.
Kind of a twofold question.
Sure.
If you're doing a first position for a seller, are you raising debt or equity for your rehab costs?
Yeah.
Because what I'm finding is that if you do give them a first position, there's no lender that's going to give you a second for your debt or for your rehab costs.
That's correct. Yeah, we are going out and raising the CapEx when we put them in a first position. Because you can't, and it is, you're absolutely right. It is tough to get, you're never going to get a bank to secure typically in the second position right now. We struggle with that. We have $7 million in equity in one of our buildings, and there's a first position, a small first position, and they wanted it to subordinate, and they wouldn't do a second position. I'm like, there's $7 million in equity. I'm just asking for $4 million in leverage, and they wouldn't subordinate behind the first. So yes, you got to raise the CapEx when it comes to first position, but if you can get them to hold 80 or 90% first position, depending on your CapEx, that's still going to be lower than having to raise 33 to 35% for a traditional down payment, even if you got 70% leverage on the purchase price and the CapEx. So the goal is to just get that total cost of capital down. Great question.
Thank you.
Yeah.
When you talk about the 3% accrual over time,
Yeah.
where is that money? And is that just kind of like an extra chunk of equity that they're being paid out at the end?
Yeah, where is that money?
Yeah.
It's the fugazi, it's a fugazi, it's a woozy, it's a wad. It's not real. Like, because money's not real. It's dead, right? It's not, none of it's real.
Yeah, no, I get
None of this is real. Like none of the, when a bank goes to give you a property, when a bank goes to give you a mortgage to buy a commercial asset, do you realize when they say, all right, I'm gonna give you a mortgage for $8 million, they just create that $8 million. It's not real. That $8 million is fake. They just put it into an account and just write 8 million on it. That didn't exist anywhere. They just created it. It's all fake. So sorry,
just kind of like
got me
putting
fired
the
up. You got me
idea-
triggered. You got me triggered with
No,
the
no,
fake
no.
stuff.
I get it. Money's fun. It really
The
is. So it's like-
3% is accruing. So it is basically paid at the end from the profit, but it's not a real number that's being like, you don't have to like take that number every year and shell it into like an escrow account.
Yeah,
It's
yeah.
just a number that is accruing on the back end that then just gets paid up.
So you're just showing it to them as if it's like, oh, in this year, you're almost getting 6%, but you're really getting 3.
You're getting 6, but you're just getting paid
Yes,
3.
exactly.
Yeah, you're getting paid 3
Yes.
annually.
Yes, and eventually,
Yeah.
the cumulative.
And then the other
3%,
3 is just accruing.
Yes.
Right? And that's just how we like to do it to lower the burden on the property annually. But you can do it however you want. Like if they said, no, I want all 6, okay. Well, then I'm going to lower my down payment, or I'm going to, do something else because now they want all 6. That's going to burden my operating expenses for my property.
Yeah.
So then maybe I will adjust something else, like the purchase price or maybe the balloon or something like that. But yeah, that 3% is just accruing.
Okay.
Great question.
Okay.
Sorry, I got triggered on the fake stuff. Go ahead.
Is it usually pretty easy to figure out, I mean, especially going through a broker, how much equity the seller has in the property? Is that usually pretty easy to get?
Yeah, most of the time it's public information. The mortgage note balance, all of that stuff. I mean, probably 90% of them are public information. I'm looking at my group here for people that are searching for properties. So the mortgage balance is typically public information. So then you look at that price they're asking, you know that there's a difference there, and you can basically tell them how much equity they have. Great question. 2 minutes.
Avatar.
Yeah.
I've been seeing lately a lot of sellers that like have notes that are called in 5 years, or interest only payments and in 5 years. Is that something that you could it work for creative financing?
You're saying they have a note that's due in 5 years?
Not a due, but the interest payment ends in 5 years.
Yeah, so that's fine. What I'm going to try and answer your question the way I think you're asking it, and be careful when you guys are setting up these balloons in these terms, because if you set up these balloons in terms in 2 or 3 years, right? We don't know. Next year's an election year. We don't know what's going to happen. I would be careful, and I would be trying to get as long of a term as possible, because you don't want these balloons typically coming due in 24, 36 months when there's a little bit of uncertainty. My personal opinion is that it's probably going to stabilize out after about 24 months from now. We're going to start to see us come back into a bullish interest rate environment, but it's going to be a little bit hairy in the time in between. So like that's why nobody's doing these crazy like 18-month BRRRR refi things that were really popular 4 or 5 years ago, because you do that 18-month BRRRR refi, you're coming out into a 7.5% interest loan, like your deal may not work.
And question, how do you base your pro forma on the rents? Like you say 3% each year, or you stretch as less than 3%, or 3% is something healthy?
How do we do preferred equity?
Like you think your rents are going to increase every year 3%?
Yeah, I don't do an increase.
Okay.
No, I just do a fixed interest rate. No, most of the time, a fixed interest rate will work for them. Good. And I can answer your question later if I ask some more questions and answer it better. Go ahead, and it's the last three.
You mentioned that the seller in that case, in one of those, was going to be making more in interest than he was currently in total income.
Yeah.
And so I'm curious, is that a big opportunity in terms of how we pitch the deals where, you know, you get the tax advantage and everything, but essentially you're eliminating all the grief and the tax burden.
Yeah.
But so I'm just wondering, is that a way to pitch it, that we're going to continue your income as it is, but without any of the overhead? That's
the only way to pitch it.
Okay.
To me, it's a no-brainer, especially if they're interested in selling. Like, hey, I'll give you a nice down payment. You can go enjoy the money. You don't have to worry about the property anymore. And every single quarter, you're going to get a check for more money than you're currently getting. We have deals that are penciling that way, you know? So yes, that's the only way to pencil it. Yeah.
Hey, sir, thank you. I'm extremely new. I was trying to get the first page of that. I wanted to read the whole thing. Is there a way I can get that, or could you scroll back to it, or would it be easier if I got with somebody who could, I guess, let me read
Yeah,
it
come
again?
find me. I'll give it to you.
All right,
You want the first page of the LOI, like the?
Yeah, I just wanted to read the whole thing so I can understand it.
Can you guys throw that up on the screen? Actually, hold on.
Yeah, I will. Yeah, sorry, I'm going to
Join the group. She said. Join the group. We'll tell you guys about the group later. Yeah, you can throw that up on the screen. Can you take a picture of that? Last question.
What would you say the top one or two objections are when you provide three different options? Does that start to confuse them? Does it push them away often, or what do you typically see?
Yeah, great question. I think the top objection after when you break it down, it's a little bit easier for them to wrap their head around, because they have to see annually, year over year, what they're getting. Because when you just have a phone conversation and you try and explain this over the phone, like 90% of sellers, right over their head, they're going to glaze over, or maybe they're sophisticated enough, but like you have to build that trust. So I think the biggest objection that we get is, in this type of scenario, there has to be a lot of trust between the seller and us. And I have never negotiated a deal like this that didn't go through an in-person appointment. So maybe we sent the LOI and it piqued their interest, but the second it piqued their interest, I'm setting an in-person appointment, because I just bought a 5-unit deal, a small one, 90% owner financing, held a note just like this, gave them a little bit of the upside. And it's like, the only reason I did that was because I went and sat with them for 2 hours. So the biggest objection I get is them trusting you enough to not screw up the property, because now what they're doing is they're tying their profits into the deal again.
Sure.
So it's really a trust thing.
So then on top of that, would you say that more often or not, this is something you'll see more sophisticated sellers be open to versus a newer or unsophisticated or not so sophisticated seller?
No, not necessarily. Okay. You know, like an unsophisticated, like it's your job to educate. What we talked about, raising money. In this scenario, like it's my job to educate them on options, because if I'm being honest with you, 70% of sellers don't know that this type of stuff is even possible for them. They think the only way to sell it is to call a broker, sell for cash, pay the cap gains tax, let the money sit in the bank, or have to go 1031 and try and find something of similar returns. They think that's the only way to sell a property. A lot of them don't know this. So you have to educate first. Be a consultant, ask a lot of questions, figure out if it's even the right fit for them. Because a lot of times you can't just start sending these and the people have, like, it might not be the right fit. And we'll tailor it to them, to their exact situation. I'm letting the lines pile up. Jason, you come up here if you're ready.
Did I hear you say you were going to keep about 70% of a transaction? Does that mean that you were 70% equity holder, and do you factor that 70%? Is it typical? How much percentage of the deal do you basically enable yourself to keep with most of these transactions? And the last part is just, when you were talking about annual income before, did you factor that ownership interest into your income, or was that entirely separate because it'll be something you realize, I'm assuming, over time?
Yeah, so I will, we're trying to keep as much equity as we can, because that's what the name of the game. You guys remember yesterday, it was equity plus units. So I'm trying to keep as much equity as I can. I will give the investors, sound bad, but I mean, I'm going to give them whatever amount of equity they need in order to hit our benchmarks for their returns. 15% IRR, minimum 6% cash on cash, 18% average annual, and I want to double their money every 5 years. If I only have to give them 10% equity to do that, because maybe the pref is really high or there's a lot of upside on the deal, I'm only going to give them 10% and I'm going to keep 90.
Thank you.
Yeah.
Hey, how you doing, man? I'll be quick. I'm big on tools. Is that a calculator available to us, or it's not really? the tool that you had, the Excel sheet with the
Yeah.
calculator?
So
put in the numbers.
it's a proprietary one that we created for seven-figure multifamily. Bill will talk about that tool and how it's available to you guys, and Bill will talk about that a little bit
Okay,
later
I
today.
got you. So
Yeah.
I jumped the gun. Sorry.
Yeah, you need some tools. I'm with you.
Yeah, I'm big on tools.
Yeah.
Software guy, man. So I
We'll
need
give you
tools.
some tools.
Got you, man. Thanks.
Yeah.
All right, was that great, everyone? Let's give it up for Chad.
What is up? Okay, we finished up. I have precisely 42 minutes of Q&A available for you guys. I have a list of questions that I want to hit. If you guys have any questions based on anything that you've heard over the last 3 days or 2 days, drop them in the chat if you haven't already asked them. If you've already asked them, I have a list of all the questions, and I'm about to start hammering through. I'm going to tell who asked the question. And if you guys want to drop them in the chat, I'm actively monitoring the chat for questions as well. So Calvin asked, is it necessary to take the course to get started? Absolutely not. You don't actually have to take the course to get started. I do recommend you get a little educated before you dive head first, but no, you don't need us. You don't need anything that we offer to get started. Again, you're stroking a check for speed to gain experience and stuff faster than finding it out on your own. Adrian Gillis asks, how do you do proper market research? Great question. So I look for specific markets that have driving factors such as median home prices, median household income, population growth year over year, population growth decade over decade. So I like to look at certain drivers in the markets, minimum population, those types of things tell me I'm in strong markets. So just for instance, minimum population 50,000 in a market. If it's a smaller than 50,000, I need it to be close to an MSA that has at least 250,000. So if it's like a tertiary market outside of Atlanta or outside of Nashville or outside of Charlotte or something, then I'm okay if that sub market has under 50,000. But I'm likely not buying an asset out in the boonies that has, you know, less than 2,000 people, and you're buying a 25 unit apartment complex and you're basically the mayor and you get keys to the city. The other thing that I'm looking at too is median home price. I like to see median home prices over 200,000, over 250,000, only because I don't want somebody to be able to go buy a house, even with today's interest rates, and get a mortgage for cheaper than what they can pay me in rent. The other thing I like to see is median household income above 50,000 a year, because that tells me that I'm, based on where my rental numbers are, that I can actually, you know, rent to people that can afford to live there. So median household income. And then I like to see population growth decade over decade and year over year. I like to see that people are moving in, not moving out. It's one of the reasons I don't invest in California. Hope that was helpful. Finding ways to increase NOI through expenses and income. Yeah, so you don't necessarily have to raise rents to increase your NOI. You can decrease expenses. So that just comes down to reading a lot of narratives, reading a lot of T12s and rent rolls, and understanding where you can press, where you can maybe cut contract services, negotiate cable contracts, negotiate utility bill backs, things like that in order to drive your net operating income. It's not just about going in there and hiking rents on people. It's about figuring out how to cut expenses. So there's a lot of ways. Jason did a whole thing on asset management. Some of these questions are from day one. So I think we answered some of them with some of the presentations. So if I breeze through them, it's because I feel like we answered them on some of the presentations in day two, because I'm starting on day one. I need to learn, Gary said, I need to learn how to structure the deals for my investors and partners raising capital and how to use depreciation to my benefit. Yeah. So, you know, you're going to structure deals however it makes sense. I just said it at the end there, but I'm going to try and keep as much equity as I can while giving my investors as much as they need to hit their investor metrics. And then when I have the general partnership equity bucketed out, then I can figure out who I need to bring onto the GP team in order to get the deal across the finish line. If you have, you know, 40% equity on the general partnership to give up, or that's how much you have, you need to figure out who else you need on your team. If you need somebody who's going to raise capital, they're typically going to take 33% of the general partnership structure if they raise the whole capital stack. Okay. If you also need someone who needs to bring their balance sheet and guarantor the loan, they're going to be another 5 to 10%, maybe even more if the loan is volatile, if it's a volatile property. If you need people on the ground, boots on the ground to do due diligence and like walk the property and be there all the time, that asset management person is going to need a cut of the equity. So it just comes down to your ability to negotiate, your ability to have conversations. It's going to be just your ability to, you know, do that kind of stuff. Are you aware of the possibility of depreciation tactics in Canada through similar cost segregation studies? You know, I've got a lot of questions about Canada. and I don't know the answer, but I'm going to call my cost seg guy right now, who handles all of my cost segregation studies, and see if he can answer this question real quick for me. I hope he answers. I'll put it on speaker so you guys can hear. There's a lot of Canadian folks that are asking, so let me just see if he can do. Calvin, let me see if he can do it.
Okay.
Boom, quick question for you, brother.
Yep.
Hey, cost seg studies and the depreciation tactics, do they work the same in Canada? I got some Canadian investors that are just curious.
If they file taxes in the US.
Then they can do, if they file taxes in the US, then they can take the depreciation benefits from a cost seg study?
Correct, yeah. So I have clients that have properties across the border that file taxes in the US, and then, yeah, it works exactly the same.
Even if the property is located in Canada?
Correct.
They just have to have what if they also file taxes in Canada? Is that okay? As long as
If they're filing taxes on the property in Canada, then it would be totally different and outside of our scope. It's more so if they file taxes on the property in the US.
understood. Okay. Thank you, brother.
Okay.
I appreciate
No
that.
problem.
Thanks. All right, bye. Hope that answered your question. I call in the experts. I know what I don't know, so I don't want to say something. So if you file taxes in the United States, then you can take all the benefits of depreciation. So, Gary, I mean, structuring deals, it's just, structuring deals is like, it's just what can you keep on the general partner side while giving up, and I don't like nickel and dime your partners on the deal, especially when you're just getting started. Like I was willing to give up a lot of the equity in the beginning just to get my feet wet. And then now that I'm a little bit more seasoned and I have a balance sheet that can sponsor some loans, like I don't have to give up as much equity. Like I own 100% of this building that I'm in right now. I own 50% and more on some other buildings too, because now I can actually do more of the deal without having to bring in partners. But in the beginning, don't be afraid to chop up the pie a little bit to learn. So how can we have a loan with a bank that doesn't approve me? You can't unless you bring on a sponsor. So you need to build a relationship with a sponsor. And if you build a relationship with somebody who has a balance sheet or a net worth equal to the loan amount and cash reserves equal to 1 year's worth of principal and interest payments, that can help you qualify for the loan. And it doesn't have to be one individual. You can have 2 or 3 individuals that pool their net worth together and they pool their cash reserves together to qualify for that loan. But you're going to have to partner with somebody who's got a balance sheet. Yeah, if you join the group, I'm monitoring the chat while also looking at the questions that came up over the past couple of days. So if you join the group, we will help you guarantor your loans. We have people in the group that are just doing that for folks. And then like I'm the guarantor on probably like 4 or 5 members' loans that just needed help with their balance sheet to qualify for the loan. It's kind of the part of the benefit of the group too. And like I'm not going to do that for random people. Like, no offense, but like you kind of have to come into our world and I got to like know, like, and trust you. I'm just not going to can't come off the street and be like, hey, I worked hard to build my balance sheet, so I don't just throw it out to anybody. But yeah, that's a great question. Yeah, we'll help you out with that 100%. Who is the best lead finder? Anita, who is the best lead finder? I need you to expand on that question. Leonard Lay asked exit strategies. That's all I got there. I think he just wants to know there are 2 exit strategies. Selling the property and refinancing the property, the only 2 capital events where you can actually pull money back out and distribute to investors. What I will tell you is all takeoffs are optional, landings are mandatory. You do not have to buy the property, but once you buy the property, you do have to exit the property. There was somebody in this chat that said like, well, why are we even talking about getting out in 7 years? Because isn't that just a long-term flip? Like, why aren't we holding these things forever? Yeah, I want to hold everything forever. But you have investors in these deals that want their money back. So like the idea that you're going to hold forever is just, I mean, it's kind of a fallacy unless you're buying it yourself with all your own money. So your strategy can be to refinance and hold for a long period of time. But at some point you're going to have a capital event. We call it an exit, but it could be a capital event. And at that point, you're going to want to make sure that your equity can pay out your investors and get their money back with a significant return if you're going to end up keeping that property. So takeoffs are optional, landings are mandatory. How much do you give up to a loan guarantor? Again, it depends on the volatility of the deal, but anywhere from 5 to 15% of the GP. Of the GP, not of the deal. Remember, that's different. I'm talking of the general partnership share. It's going to be 5 to 15%. I've seen up to 20% on like a very volatile deal. but 5 to 15% on a guarantor. Super clean deal, stabilized asset, small property, I might be giving 10% of the GP. So if you're keeping 40% for the GP, that's 4% of the deal. So I'm taking 4% of the deal to guarantor it for you. Hope that answered your question. Downsides of owning commercial real estate. Great question. Downsides of owning commercial real estate. There are zero. I'm just kidding. I'll tell you the downsides are that it's illiquid. It's much more illiquid than some other assets that I own, paper assets, stock market, things like that. Even cryptocurrency, which I do believe in because I think we need to get to a decentralized one that's not being run by a bunch of money hungry, money laundering, corporate government, bought and paid for corrupt people. But that being said, I think those paper assets are a little bit more liquid. Commercial real estate is a little bit more illiquid. Downsides, obviously, the lending environment right now is preventing a lot of deals from getting done. The other downs, I mean, I just don't know any other asset class that provides you tax benefits, cash flow, appreciation, preservation of wealth, like capital preservation and multiplication. Like there's just none that provide all the things, which is why I'm so passionate about it. But obviously, you know, there are downsides, right? I have about 55 million in debt on my name. It's all good debt paid by others, but it is debt. And if the whole world collapses and they call all that debt, like there's risk, right? But that's the risk that I was willing to take to get wealthy fast, was to use good debt in order to do it. So you guys have to make that decision for yourself. What's your risk tolerance? I was willing to let fake money go levered on me personally, which is all personally guaranteed, that's paid down by other people in order to get wealthy. But the downside is if those banks go under, if the whole system comes down and they call that debt, like that's my downside. It's my exposure. I could lose it all. But the ups, what if you don't buy commercial real estate and the dollar just keeps getting hyperinflated and you have you have everything sitting in a 401k, you're planning on retiring on that stuff, and then it becomes worth nothing. And they say, hey, your pensions are gone. Like what happens? What happens then? You're going to wish you'd bought some places where people need to live. How do we add ourselves to sites? Good question, Manuel. Add yourself to sites by going to the website of the brokerages, and 9 times out of 10, they have a little tab up top that says contact us, and you can send them an email with your criteria and they'll add you to their list. And like 80% of them have this button that says add yourself to our list. Like just go to every broker's websites that's in any one of your target markets, and just add your contact information, your phone number and email, and just write a little blurb about yourself, like what you're looking for, and you'll go straight to their short list. So you don't have to wait till deals go to LoopNet. Like they'll email those deals to their list, and you can start to increase your deal flow. And then you start to look at T12s and rent rolls. Good question. Do you have experience with trust and developing structures with trust? I have a personal trust for my kids. Everything's in my personal trust. I don't technically own anything. So if anything happens to me, it all goes into the trust. But we don't set up our assets. I mean, our assets are owned by the trust, but every asset is owned by its own individual LLC. Linda asked, the information being shared is a bit fast. I'm a bit lost with the numbers, knowing if it's a good deal in underwriting. Yeah. It's not really a question. I'm sorry that we went quick. You can rewatch it for the next 48 hours and watch the numbers presentations again. What is the IRR on a deal? How does it differ from cash on cash? Internal rate of return is internal rate of return. IRR is your total return on your investment over the time period that it's held, factoring in the time value of money. And then cash on cash is just strictly the cash outlaid based on the cash flow that's coming in through distributions, that percentage return on the capital that you put out. That's cash on cash return. Internal rate of return includes your capital event or your equity event in year 5, 7, 10, whatever it may be. It includes that event. And then it's the total return on your investment plus what divided by what you actually currently invested divided by the number of years held, factoring in time value of money. Pull up a deal and underwrite it live, play with some numbers. Cool. I did that this morning with a little bit of the back of the napkin analyzer. I don't have time to go through a full deep dive analysis. Do I buy only value add right now? No, I'm buying stabilized properties too. Anything that pencils right now, especially if I can get good debt on it, owner financing, some owner held seconds, like anything like that, I'm buying. We're buying a 2020 built stabilized storage facility. There's no value add at all. It just cash flows really well. So it doesn't have to be a value add. I'm actually more wary of value add deals now than I was, 2-3 years ago, because the value add deals, like a lot of them are getting quoted for bridge debt and stuff. And y'all need to be careful putting any bridge debt or non-perm debt has maturity dates coming in the next 2 to 5 years. Like I'm trying to get 7-10 year debt on everything, because I don't want any debt coming due in 24 months or 18 months. Like a lot of this popular freaking Burr stuff that was like going on a few years ago, where they were doing 18-month Burr refis and pulling all their cash out. Like that ain't happening anymore, especially because banks want to see things seasoning for 12, 24 months sometimes. So just be careful of the value add deals. There's a lot of money to be made. I'm not saying don't buy value add deals. I'm saying just be careful of them. How much does it has to cash to be considered a good deal? I mean, cash on cash returns, I like to see 6%. If it's any less than that, it better be in a damn stable market and you're going on the appreciation play. But that's just a tricky play right now. I want to make sure that my deal cash flows through this market trough that we're in. Yeah, 6% minimum, 8% is great, 10% is amazing. But sub 6% gets a little hairy, because now you're relying pretty heavily on your exit, Christina. And I really don't like that. Also, I forgot to ask, this is from Calvin, what deal structure would you recommend for a first-time deal maker? Listen, I would recommend, he said preferred return waterfall hybrid. Yeah, you could do some sort of between a 6 and an 8 pref with anywhere from a 70-30 split to a 50-50 split. You just give them as much equity as they need to hit their returns. That's why understanding how to underwrite is really important, because you can always go back the other way. So I'm going to give you guys a little gold nugget here. So if I split the deal 50-50 with you, okay, and I commit to these I commit to these return metrics, 15% IRR or whatever, and we sell the deal, and based on the 50-50 split, I catch up on your preferred return, and based on the 50-50 split, you only get a 13% IRR. I can always give you back 10% of the equity to make my investors whole and get them to that 15% IRR. I can waterfall back the other direction and go to 60-40, where you get 60 to make sure investor returns whole. But it's very difficult if I go 70-30 out of the gate. So like if I go 70% to you, 30% to me out of the gate as the GP, and then I really exceed on the property, it's very difficult for me to justify now clawing back that equity if I'm hitting like a 25% internal rate of return. Now I got to like come back to you and say, hey, listen, I mean, that waterfall will kick in, but it's easier to go the other direction. So I recommend some sort of hybrid for sure. Just it all depends on your deal. But yeah, you're going to have to give away some equity in the beginning, especially because people want people are trained to kind of get equity. Yeah. Gary asked, I want the Buffalo shirt. It's not really a question, but I think there's probably a way we can get you the Buffalo shirt. Where do you see the market going in the next 2 to 5 years? I think the next 12 months are going to be really bad. And I think the next 24 months are going to be tough. And then I think the market is going to come back around in probably 2026. And I don't think we're going to be into another bullish lending environment. When I say bullish, I mean around 4%. I don't think we're going to be into a bullish lending environment until 2027. It's my personal opinion. It's all personal opinion from what I'm seeing. But I think, I get this question a lot when I speak, and I try not to go too deep into the socioeconomic circumstances that affect what we're doing, but I'd be lying to you if I said I'm not nervous for the election next year, because I think whichever direction that goes is going to directly affect how the Fed responds. And I think if they steal another election, I mean, if Joe Biden somehow gets 81 million votes, which he actually didn't get, I think it's going to be really bad for the economy. And I think the Fed's going to hold rates and even raise them more. And I think it's going to be tougher. And I think, I'm not like a Trumper. I'm not even a Republican nor a Democrat. But if Trump gets in, I think it'll be better for the economy, just because he's a businessman and he's not bought and paid for. I don't think he's the most united person as far as everybody loving him, but I think it'll be better. I think the economy's got a better shot at turning around if he gets in. And then I don't know if one of these wild card people get in, like if DeSantis wins or something, it's going to directly affect. So y'all pay attention to what's going on, because the Fed's going to respond. Because I'm telling you, if the Democrats win another one, I think it's going to be a real brutal couple years because they're going to really run this thing into the ground. More printing, more money laundering, more shit shows over there. Yeah, I don't know. Just pay attention to that stuff. I try not to let it consume me. It honestly pisses me off more than anything. So if you guys feel that, I get pissed. But I'm not a Democrat or a Republican. I'm purple, I guess, is my color if I had to affiliate. Can we do some underwriting, some mock deals? I took that back of the napkin analyzer for a spin this morning. Could you go over what to say to investors in a cold call? Yeah, guys, I'll shoot you straight. I try not to hold back. I'll tell you the truth, what I believe to be true. That's why I believe in a decentralized currency, because the federal government's bankrupt. Y'all, 32 trillion in debt, 32 trillion in debt, like 250,000 per person in the United States. We ain't paying that back. That bubble's going to pop at some point, folks. And whether you got to deal with it, your kids got to deal with it, your grandkids got to deal with it, it's coming soon. I think it's coming sooner than later too. And when that bubble pops, y'all going to wish you had some places where people need to live, because 32 trillion in debt, it's not going to be good. Y'all think a recession was bad. You think 2008 was bad. This thing's going to be way worse. So just prepare yourself financially, get your house in order. Start paying attention to your personal financial statement, start paying attention to your asset column, your statement of real estate owned. And if you pay attention to it, it'll grow. So just look at it every day, have money meetings with your family, with your spouse, talk about money, talk about wealth, talk about this stuff, guys. It's important, right? Because when shit hits the fan, you don't want to be on an island, not having discussed this with your significant other. And now you guys are scrambling, and it's going to be harder to get ahead. It's going to be harder to become wealthy. It's going to get harder to do that, right? Because your dollar is worth less. Sorry, get fired up. Can you talk about the units with tenants in there? Do you give them notice ahead of time? We answered that question in the chat. Manuel, will you help find sponsors? 100%. What is the best area to invest in? I think I answered that with some of those demographics. How do you consider the potential for growth in rent-controlled jurisdictions? I would be very careful investing in rent-controlled jurisdictions, and I would make sure the numbers pencil at the current rental rates, and I would not be factoring in any crazy rent bumps and rent-controlled jurisdictions. I only own one asset in a tenant-friendly state, and it's just a really stable play. If we don't ever raise the rents, it still makes sense. So just be careful in rent-controlled jurisdictions. Chad, adequate insurance increasing harder to acquire. Yep, making cost estimates. Can you talk about estimating these potential variances? That's a great question, Bill. So the insurance market is hardening. It's hardening really bad. So we haven't seen the insurance market harden like this in probably 20 years. And I will tell you that we are getting quoted. 2 years ago, we were quoted about 400 to 450 a door, and in relative to many markets, it was about 400 to 450 a unit for insurance costs. We're like at 700, 720 on some of these things, 650 if we're lucky. But anything's like 650 to 750 if you're in just a regular market. If you're in a coastal market, or you're in a market on the Gulf, or somewhere in like, Mobile that's got, the port and all that stuff, right? Some of those insurance costs are north of $1,000 a unit. So be careful. That's one of those fixed expenses that if you guys aren't factoring in that, it's going to bite you, because the previous owner might have a policy that covers, their original purchase, and they might be at 400 a door. And if you think you're going to get 400 a door and that's what you're underwriting, you're going to be sadly mistaken. I don't see any quotes coming in less than 600 a unit right now on insurance. That market's hardening up. And I got a tenant that I own this. I have an office building that I'm in, and I own this office building. My downstairs tenant is an insurance company. And I have conversations with him pretty often. And he's like, he's been in this business for 40 years. He's like, I've never seen it harden like this before. So it's just a collective across the country. So that's the shitty part about insurance, is like, if anything happens in any of these other markets, like, we all pay for it. Tennessee's stable, but we pay for, insurance premiums everywhere else. Let me read through these questions. Keep dropping them in the chat. I got 10 more minutes Q&A. Where and how do you communicate depreciation benefit to the seller? So depreciation benefit can be communicated based on equity left in the deal. So if they leave $1 million in the deal right now, depreciation is anywhere from 40 to 60% of the money that's left in the deal is what you're going to get dollar for dollar back on depreciation. So if If you're negotiating with a seller and he's going to leave $1 million in the property, he's typically going to get about $500,000 in dollar for dollar depreciation against his taxes. All right. 40 to 60%. It varies. I can't give you an exact number because it varies. Right. So the depreciation's number, like storage doesn't have as much depreciation, but apartments are about 40 to 60% depending on how many fixtures are in it, all that good stuff. But a 50% is a good number. And then he's getting $500,000 of dollar for dollar depreciation. So if he took any money off the table, let's say he had a $1 million gain, half of his tax bill is going to be wiped away from the depreciation you're going to give him. How many more questions do we got here? Okay, I can finish these questions. I'm going to be able to answer them all. And if you got any more, go ahead and drop them in the chat. I got 7 more minutes and I got a few more. I'm going to answer them here. How long does it typically take you to underwrite a property when you get it from the broker? Good question. So I can do a quick back of the napkin in 10 minutes, but if I want to do a deep dive underwriting and like really dig my heels in, it's going to take me every bit of 30 to 45 minutes. When I first got started, it took me about an hour to an hour and a half. So when you're newer, it's going to take you longer to underwrite. But when you start to get dialed in, you can underwrite a deal in 30 to 45 minutes. That's assuming you take it the full way, which is like you got to do rent comp analysis. I'm going to call the tax assessor's office and get I'm going to get the mill rate and try and project out what my taxes are going to be on reassessment. I'm going to maybe talk to some property managers about some expenses and some OpEx per unit. Like that's going to take you every bit of 45 minutes, if not longer, probably 2 hours, north of 2 hours in the beginning. If you're going to do a real underwriting, like full on the deal. And then I'll mystery shop some properties too. So I'll call some places that are close and be like, hey, are you guys, what's included in the rent? Is it gross? Is it net? Do we pay water? What amenities do you have? Is there washer dryer hookups? Like I'll call those places and start mystery shopping so I can start to project out what my potential rents are going to be. Could you elaborate on having the seller finance second position as well as 19% share issue? So you can't put a seller in a property over 20% equity, 20% or higher equity, because then they have to sign on the loan. So I keep the sellers, if I'm giving them equity upside, like I said, in option 3, I'm keeping them under 20% ownership because I don't want them to have to sign on the mortgage for the new property. And I'm writing them into the operating agreement. So hope that answered your question. Let me know if you need me to elaborate further. What CRM do you recommend to keep track of deal flow? You want to upgrade to something else. I use, this is probably not going to be a popular answer. I use Excel to keep track of my deal flow. There are not like thousands and thousands and thousands of leads that are going to be coming into your inbox, but we use Excel to keep track of them. We used Podio in the past. I've had Salesforce. I've had a lot of different CRMs. We're pretty effective with our Excel follow-up. So we currently use Excel to track our deal flow. And I look at a lot of deals. So I don't want to hear any excuses that you don't have. Some people think they need some robust, sexy CRM in order to be successful. And like, if you can do everything on an Excel sheet, sometimes they're even more efficient. Like sometimes those CRMs are more confusing than anything. Did I miss any questions? I don't think I missed any. At least the list that I had. If you had a question and I didn't, if you had a question I didn't answer it, drop it in the chat. I have 4 minutes left for you guys. I hope the event was enjoyable. I hope you guys got some good information. I hope you guys see that, we're a pretty open book, very transparent. We want to just make sure that you guys have all the information that you need in order to be successful in the space. If you feel like you need more, our group is here for you, 7-figure multifamily. I would definitely, if you're serious about the stuff, I would recommend getting in. If you're just kind of looking for more information, like just join our list, join our free Facebook group and just kind of plug in and get some free info. But if you're serious about getting into the space, I would definitely recommend joining our group. If you don't, thank you for hanging out with me for a couple days. I really appreciate all you guys. I wish you the best of luck in your commercial real estate journey, wherever that ends up taking you. I got a couple Facebook group name. Hey, Morgan, can you drop the free public group? Can you drop the free public group in there? Thank you guys very much. It was an honor to spend what were the 4 types of creative financing? Master lease option, owner held debt, owner held equity, and loan assumptions were the 4, Calvin. Thank you all very much. There's the Facebook group. They dropped it in there. I'll talk to I see some like private questions in here. Miria. Hey, Morgan, can you get Miria's contact information, and can you get Calvin's? Calvin Curry, they both had some private questions for us. Can you just get their email addresses? We'll make sure we reach out to you. Miria, it looks like a question that I have to spend a little bit more time answering. Same thing with you, Calvin. Yeah, Morgan's got you. Cool. I don't think I missed anything. Hope you guys enjoyed it. How can someone submit you a deal? Yeah, great question. If you guys have a deal, like even if you're not in the group and you have a deal you want me to look at and take a peek at it, I'm happy to help. You guys can email. I'll put his email in the inbox in the chat here. But if you guys, you can email John at TitanCapitalGroupLLC.com, and we can help you look at a deal if you need help. Yeah, if you email John, he'll make sure that we get it analyzed for you and help out. Obviously, if you're in the group, you get like deal reviews and stuff, but John can actually at least like get you started. But if you want the full analyzer and everything, that's within 7-figure multifamily. But we could give you a little bit of guidance if you guys have a deal that you need some help with. Happy to do it for you. Just want you guys to be successful. That's really it.
When I joined the group, I was in the beginning stages of the multifamily journey. I didn't have a lot of knowledge of the industry. You don't have to know anything. You can come in here with, really a lack of experience, and there's so much knowledge to be shared and learned.
It's given us more direction than anything else. Not a lot of knowledge coming into this, and the camaraderie with the group and the expertise that we have exposure to. That's been the biggest thing for us, just to get over some of that learning curve that we had going in.
This is my tribe. This is the people I want to be around when I was exposed to the multifamily world. Since then, we have actually just went under contract for our first 22 unit, and that is having no experience or very little, and then just coming in and getting engaged, following the process. Like, it's been amazing.
And just between July and August, I left my W-2. The very last day of my W-2, we got under contract on a 42 unit. It was quite a growing experience for all of us to know that we can put all this together in 35 days.
We went and checked out a hotel that the group had bought and fully renovated that to short-term hotel stays. Now to see it in real life and ready to go is just a very inspirational thing. I loved it. It's awesome.
That was just eye-opening to actually see it live and understand what we'd be talking about.
It's a tribe. Everyone's friendly. Everyone's here to help you. You're going to learn, you're going to grow, and you're going to grow as a shout.
All the people in the group are just such giving people that want you to be successful, and they challenge you to be great. And I mean, it is just amazing.
It just energizes you and energizes your belief.
I mean, it's been life-changing for me. There's no way I could have come to this point without this group of people.